Hey guys, welcome back. Today I'm going to be doing a follow-up video where I discuss some of the key things about setting up a self-managed super fund. This is a follow-up video I did last year, and I've been getting a lot of questions around tax, around self-managed super funds and some of the costs involved with it all. So in this video I'm just going to be covering off on a couple of these key questions that I've been getting a lot of, just so you guys are a bit clear on some of the things that I may have skimmed over a little bit in the first video. By no means am I a tax specialist or anything like that, or a self-managed super fund specialist by any means. This is just things that I've sort of learned along the way. And if you're looking at setting up a self-managed super fund, I recommend you speak to an accountant or someone that specializes in self-managed super funds, as they're quite a unique and very complicated sort of tax structure, and it's very strict on where it stands with the ATO in order to be compliant with your self-managed super fund. So it's not something you want to sort of jump into lightheartedly one afternoon. You think it's a great idea and throw your money into Bitcoin or anything like that. And you have to have a set plan. It's great going into this, having a self-managed super fund, if you have a set plan on what you plan on do with your funds once you have established it. And there is a lot of ongoing costs involved with that. So that's what we're going to quickly touch on to start off with, is the costs around it and whether or not it's worth setting up a self-managed super fund. Then we'll look at the tax on what the assets that is held within the self-managed super fund. Then also look at the pros to setting up a self-managed super fund and how that can be tax effective later on in life when you're coming up to retirement age. So we'll touch on that in the end there, so make sure you stick around for that. So what's the minimum viable self-managed super fund balance and costs? I think I briefly touched on this on my previous video, but I'll touch on it again as well. So the general rule of thumb is they say you should have around 200 grand in your super in order to set up a self-managed super fund, just to make it worthwhile for the amount it costs for audit fees and everything like that. General rule of thumb, it's going to be anywhere from $1,000 to $1,500. We're just going to have a quick look at this article here from canstart.com.au, where they do a quick breakdown of some of the fees and things and just the establishment costs for setting up a self-managed super fund. So one-offs of self-managed setup fees here, they say the trust deed is $150 to $500, and the self-managed super fund sole purpose test trustee company $500 to $888. From memory, I think it was around $1,000 to establish our self-managed super fund. We had a corporate trustee, which is a better way to go. We have since removed that corporate trustee. It's just another layer of protection. It makes it a bit easier if you're moving assets in and out of your self-managed super fund, either liquidating them or transferring them out to a different party within your self-managed super fund. So that's what we did, but we had to withdraw that in order to buy a property in Japan. But I'm not going to be diving into that in this video. If you'd like to know a bit more about that, drop it in the comments below. But just quick breakdown on some of the fees here. Just quickly touching on some of these things here. Those structuring advice, they say anywhere from $665 up to $1,660 there. When it comes to setting up a self-managed fund, I highly recommend talking to actually a specialized accountant in this space, or someone that just really knows self-managed super funds, because I know there's definitely ways you can set these up online, and I'm not too sure how they work because that's not the way I went with it. But I think this is something you really need to sit down and discuss your plan and come up with a plan with an accountant. Depending on your accountant, if they're good, they won't sort of force you into trying to set up one just because they want to be taking those fees, but they'll just hopefully talk you through it. If you have a good recommendation from a friend or something when it comes to setting up a self-managed super fund, that would be the best way to go as well. For me, we went with our accountant that we already used, so we already had a bit of a relationship there, so he understood how it worked for us anyway, so that was quite an easy transition for us when it came to set up the self-managed super fund. And that was also my in-laws, they use the same accountant, so it was pretty familiar there with it all, and that's worked out well for us. And that was just through our local accountant here in Tasmania. A couple other different things here. It says the asset corporate fee $45, ATO supervisory levy $388, and if you're buying and selling ETFs or hybrids or shares, whatever it may be, on average about $33 per trade by the looks of things there. So this is what they're saying, and they've got a little example here. So you're looking at annual costs of just over that $1,200 on the basis of the 1% fees rule of thumb. That would mean that someone would need around that $126,000 would find it achievable to run a self-managed super fund cost effectively. That is if you're going for that 1% fees. And this is about where we sort of started off setting up our self-managed super fund. Me and my wife both put our supers together, which gave us around that, I think it was around 100 grand to start off with, and then we started to grow that a little bit. But to be honest, I was actually thinking about closing our self-managed super fund down for a while there, because it was just costing a lot in fees, like they say. And we didn't really have a set plan. We were going to invest in real estate, but then it's quite tricky to get loans through self-managed super funds, which I discussed earlier in my previous video. But we ended up buying a property in Japan through it as well, which worked out very well for us. But there's definitely some things to think about there, especially if you're looking at investing in property. I would suggest that you speak to someone that specializes in that. That's enough on that. Let's move over to, and look when it comes to this, it depends who you talk to. So they go with that general $200,000 as a minimum. But then if you read this other article here, this is also from CanStar. This lady is saying that she thinks you need $750,000 to open a self-managed super fund to make it worthwhile, the time and effort and the risk involved. And there is a lot of work and effort that does go involved with running a self-managed super fund. It's almost like running a small business, let's say. You've got a lot of things that you need to keep on top of, and audits. You won't personally be doing the audits, but your accountant has to. And so there's some definitely things that you need to sort of, factor in whether or not. And if that's something you enjoy and you enjoy doing research around different investments and things, then by all means, I think it's a good move to go. Or I have done another video where I discuss choice fund, which is sort of a good interim between setting up a self-managed super fund and just your regular super, where it gives you the freedom to invest in different ETFs and shares and things. And I sort of weigh up the pros and cons on that as well. So definitely check that one out if you want to just sort of set up one, just so you can sort of start, buying and selling maybe a few shares or different ETFs and things around that. And so let's just jump in and have a look at some of the tax components and also capital gains. This is something that you need to be aware of. I'm sure most of you guys are, but it's just something to be familiar with as well when it comes to capital gains. This is for inside your super and also outside of your super, regardless if it's self-managed super fund or you're just everyday investing. It is key to hold assets for longer than that 12 months, even if it's 12 months and 1 day. That way you will be entitled to a 50% reduction on the capital gain. So that's pretty key. When it comes to investing, you want it to, obviously it's good to pay your taxes. You need to pay your taxes, and I'm not trying to say you should dodge taxes by any means. But if there's advantages to sort of working the system a little bit, let's say, and this is one of them. You want to hold assets for the long term, longer than that 12-month period, which will give you a 50% reduction on any capital gain that you would have made from that investment, whether that's property or shares or whatever the particular investment vehicle that you have. Especially if you're maybe in Bitcoin and recently you've had a huge run up, you think you want to liquidate. When did you first purchase this Bitcoin? And got to sort of weigh these things up when it comes to taxes as well, because the ATO will get onto you. So definitely do your research around that. Just quickly here on the capital gains discount method. So eligibility for assets held for 12 months or more before the relevant capital gains event. So not available to companies, so bear that in mind as well. Don't try and do this through a company. But like I said, I'm not a tax expert by any means. If there's something here that I may have glossed over too quickly or is not correct, and you are a tax specialist, drop it in the comments below to correct me, anything that I may have sort of mistaken here. For foreign residents and individuals, the 50% discount is removed or reduced on capital gains made after 8th of May 2012. Like I said, these things are always changing and evolving as well. Unless you're in this space watching it daily, things that do change as well. So definitely bear that in mind. So description allows you to reduce your capital gain by 50% for resident individuals, including partners in partnerships and trusts. So that's also something to discuss with your accountant as well, whether you should set up a partnership or a trust or something along those lines. But 33.33% for complying super funds and eligible life insurance companies. So just quickly on the capital gains there, guys. Let's have a look on the tax on your income. This is from any assets held within your self-managed super fund. I've had a couple of questions around this. How much tax do I have to pay on any income that you may be receiving in your self-managed super fund? So the income, this is direct from the ATO, guys. Everything we're discussing today, I'm going to leave a link in the description so you guys can do your own research around this as well, which I highly recommend. Don't just listen to me. The income of your self-managed super fund is generally taxed at a concessional rate of 15%. This is a general good sort of rule of thumb to live by. And in the end, we'll sort of go over some of the loopholes around this and the tax structures that you can use for later when it coming closer to retirement stage of life, coming up to that sort of past 60 years of age. But anyway, what we're talking about here is the concessional rate of 15%. So this is on any rent that you may receive or dividends or anything like that. You'll be getting taxed at that 15%. Okay, so that's pretty key. And this is only on realized gains. So even if you were to liquidate something, and then you need, everything gets returned into cash, that's when you will be having to pay tax on that. But it's only on realized gains. It's not, let's say you bought a property 5 years ago for 300 grand and now it's worth 600 grand, let's say. You don't have to pay any tax on that capital gain until you liquidate that asset or sell that asset on. So that's something to bear in mind as well. I think I had a couple of questions around that. Do I have to pay tax on it if I haven't sold the asset? No, you don't. It's only when you sell the asset that you would have to pay tax on that as well. But you do have to pay tax on any income that you receive in your self-managed super fund as well. And then there's caps on things, you can contribute up to 25 grand a year as well. We're not going to go into huge detail on that, but these are things that you need to talk about with your accountant, because everyone's sort of tax is different, and depending on how much you earn per year, and depends how much you can salary sacrifice into your super and things like that. So it's very hard to give sort of general advice around any of that, which, like I said, is definitely recommend speaking to a financial advisor or someone that is qualified in that space to give you some good advice when it comes to that. Lastly, we're going to look at superguide.com.au here. They have a very good example around capital gains tax in the accumulation phase when it comes to capital gains. So this just gives a clear example of what I basically went over when it comes to capital gains. So, for example, if a self-managed super fund bought an asset 3 years ago for 100 grand but sells it for 120, the capital gain made on that asset is 20 grand. So that's pretty self-explanatory there, I feel. Conversely to that, if you were to sell an asset for 80 grand, the fund would experience a capital loss of 20 grand. So we don't really want capital losses, but you can sort of weigh the capital losses against any capital gains as well, and then whatever's left at the end of that is what you would pay the tax component on that. But here, this is the last bit that I want to sort of highlight to you guys. The tax imposed on that gain depends on whether a self-managed super fund is in accumulation or retirement phase, and whether there are members in each of those phases. So this is something that's pretty key as well, depending on how many people are within your self-managed super fund, how many trustees or anything you have in your particular super. For me, it's just me and my wife. We have a very similar age. But let's say that you're 60 years of age and someone else in your fund is only 50 years of age, then there's a good 10-year gap there. So everyone's sort of coming in and going at different phases. And so that's something you need to think about as well when you're setting up your self-managed super fund. People will be entering retirement phase earlier or later than yourself, so also something to think about as well. As income earned in retirement phase is tax-free. So this is pretty key here, guys. Also, if the asset is sold in retirement phase, the fund will have no tax liability on the capital gain. So this is pretty big incentive to keep things in your self-managed super fund until you reach that retirement phase, definitely limiting the tax that you will have to pay if you hold them in your self-managed super fund for a long time, which is what they're trying to encourage as well. So that's the last, and this is the last thing around ages here, guys, is before we wrap it up. So if you're age 60 or over, your entire benefit from a tax super fund, which most funds are, is tax-free. So that's just basically saying what I just went over. So that's if you're over 60 years of age. If you're age 55 to 59, your income payment has two parts: taxable, tax on your marginal tax rate, less a 15% tax offset, and tax-free, you don't pay anything more. And if you're age 55 or younger, you can usually only access your super if experience permanent incapacity. If this happens, you'll be taxed at the same as people age 55 to 59. If accessing super for a different reason, such as severe financial hardship, your income payment has two parts: taxable at your marginal tax rate, tax-free, you don't pay anything more. And then they have special exemptions for this as well, like they had last year with the whole health crisis that we lived through. You could withdraw $10,000 each financial year, so in total you could withdraw $20,000 from your super without any sort of implications around that. So these are things that they roll out from time to time as well if they need or they see the use for it. And look, I don't want to discuss the pros and cons behind that. Generally, you're ruining the power of compounding interest if you're just withdrawing 10 grand now to. Unless you really need it, then by all means, I think it was a good move. But I think a lot of people didn't really need to withdraw that money. But I'm not going to judge or anything. Do what you do, you. But anyway, guys, hopefully you got some value from this today. Like I said, by no means am I a tax expert by any means. This is just sort of some basic stuff around some of the taxes when it comes to self-managed super funds. If you've got any questions on anything I covered off on today, guys, drop it in the comments below and I'll do my best to sort of help you out where I can. If you enjoyed today's video, guys, it'd be much appreciated if you hit that like button. It helps me out a ton. And if you want to see some future videos like this, make sure you hit that subscribe button and you'll be the first to know when the next video drops. With that said, guys, we'll wrap it up there and we'll catch you in the next video. Cheers, guys.